So we're going to go ahead and get started. Good evening, everyone. My name is Elizabeth Aloni. I'm with Schneps Media. Schneps Media is the largest local media company in the New York metro area with over 100 publications from Manhattan to Montauk, Palm Beach, and Philadelphia. And tonight we are thrilled to be able to bring you a really important webinar. And we're going to have an opportunity to explore what it takes to buy your first home. And before you get too far in the home buying process, we're going to help you make sure that you're ready to own a home. We have wonderful experts with us here today. Let me introduce those to you who will be able to give you this wonderful information. First, please welcome David Colby. He is the Director, Lending Sales at MCU, Municipal Credit Union. David's been in financial services for over 2 decades and with MCU for the past 3 years. His teams support MCU's members with all of their lending needs. And a fun fact about David is that he loves to fly and he's working on getting his pilot's license. Amazing. Hi, David. Welcome. Now, please welcome Omar Osoria. He is a mortgage sales manager at MCU. Omar has been helping MCU's members since 2014. He supports a team of 5 mortgage loan offices dedicated to supporting members on their road to home ownership. Omar loves sports and attending all types of sporting events, but I think he has other likes as well. Welcome, Omar. Now, please welcome Walter Skowronski. He is the mortgage sales manager at MCU with 20 years of mortgage experience. He's been with MCU for the past 3 years, helping MCU members realize the dream of home ownership. Walter loves social events and singing karaoke. That's a fun one. And last but not least, please welcome Deborah Sinodinos. She is the business development manager at MCU, where she has been a valued team member for 13 years. In her role, Deborah oversees a team of business development officers dedicated to enhancing and growing the MCU membership. Fun fact, Deborah made the transition from teaching young children the fundamentals as a preschool teacher to educating adults about credit unions. I don't know. Is that very different? Maybe. Some ways yes, some ways no. Anyway, welcome, Deborah. So thrilled to have all of you here. I'm going to turn it over to David and he'll get moving with this great information.
All right, perfect. Good evening, everybody. And Elizabeth, thanks so much for the warm introduction. My name, again, is David Colby. I'm the Director of Lending Sales at MCU. Again, we're really excited to bring you this information tonight. The chat is open, so feel free to ask questions as we're presenting. And again, the presentation will be shared with you after the fact. And just to reintroduce again, we got Walter Skowronski and Omar Osoria, along with Deb Sanadinos on the call tonight to help facilitate this presentation. Omar and Walter's contact information is on the screen here. And again, if you have questions after the webinar, please feel free to reach out. We'd love to talk to you. Just a quick disclaimer from our friends at Legal. So MCU has provided this presentation for information and illustrative purposes only and assumes no liability to any persons for its content or any person's reliance on that content. The presentation does not constitute legal or tax advice. Each borrower should consult with a qualified legal, tax, real estate, and lending professional with respect to his or her particular situation. Just a quick overview. So in the presentation tonight, the goal is to help arm you with enough information to understand the home buying process. There's a lot of different people that are involved in the home buying process. And for most individuals, this will be the largest transaction you're ever going to do. So we want to make sure that we arm you again with enough information to help answer questions, discuss what's part of the home buying process, who's involved, and how to obtain a mortgage. So topics we're going to cover tonight on the real estate section. So am I ready to buy, right? Should I buy or not buy? Can I get a mortgage? Down payment and closing costs involved. We're also going to cover what do you need to know. So who's part of the home buying process? Terms to know, what's in a mortgage payment, and then getting started, how to obtain a copy of your credit report, the difference and the nuances between a pre-approval and a pre-qualification, and then how to find a realtor. So without further ado, I'm going to turn it over to Omar Osoria, who's going to take it away.
Good afternoon, everyone. Here from Municipal Credit Union. My NMLS ID is 1950417. And I just wanted to go over right now some terms you should know in the process of purchasing a home and going through the home ownership process. There's a lot of terms that realtors, loan officers, and everyone during the process will throw out. So I'm going to provide some brief definitions on some of the terms that you may encounter. That way we have a quick understanding on, what they mean. So the first term is amortization. So it's the repayment of the loan principal over time that consists of both principal and interest. And your loan balance declines by the amount of principal scheduled in the payment. Another term is annual percentage rate, also expressed as APR. The APR shows the cost of your mortgage loan as a yearly rate. It includes upfront fees, such as points and as well as interest, and it's intended to show the true cost of your loan. And when comparing two lenders, it's always important for you to take a look at the rate as well as look at the APRs and see what the difference is. The lower APR would result in most likely the better deal. Closing costs. It's the cost that you will have for pretty much obtaining the mortgage and in addition to the down payment. The closing cost is usually between 3 to 6% of your loan amount. Credit Bureau, it's the agency that collects the statistics on individual payment records such as loans, credit cards, and other debts. We work with the three major credit bureaus with this Experian, TransUnion, and Equifax. DTI, which is also debt to income ratio. It's the ratio of all debt payments, such as mortgages, car loans, student loans, credit cards, bills, divided by your gross income, expressed as a percentage. When looking at your debt to income ratio, please try to, make sure that you're below a 38% rule, which we'll cover later on. Home equity. Home equity is pretty much how much equity you've obtained with the property that you currently own. So it's the actual property's current market value, less any liens or mortgage attached to that home. You can increase your principal payments to make sure you have higher equity. Escrow is an account set up on your behalf in which your portion of your monthly payment is held to pay the property taxes and insurance. It's usually 1/12 of that amount. You make that monthly payment to your escrow's account. That escrow account will hold those funds there for us to make that payment towards your annual taxes and insurance. Gross income is the amount earned before the taxes or payroll deduction. So it's the amount you earn before anything has been deducted from your pay. Points is a percentage of the loan amount. And in order to lower your interest rate, you must purchase the points. It's always important that we do an analysis before you purchase the points, just to make sure that the points that you're purchasing make sense to lower your interest rate. Pre-qualification, it's a conversation that we have between someone who is looking to be pre-approved, but before you pre-approve, you may want to pre-qualify, see how much you are looking to obtain, and see if you're within that range. It's a loose estimate that we can provide and let you know how much you can afford. Pre-approval is a commitment from the lender to make a specific loan to a borrower prior to identifying the property. Even with there's a pre-approval in place, there's no guarantee you'll get the loan, but you have great odds to, once you place that offer on a home, to receive that loan. Okay, so during the home buying process, some question may arise: to buy or not to buy? Before you get too far in the home buying process, just be sure that you're ready to own a home. And here's some factors to consider. Some of the advantages of owning is that you're building equity and a better future home. Another advantage is there is a sense of community. If you're doing a mortgage, and whether you decide to do a 15, 20, 30-year mortgage, you're going to be a part of that community for a while. It's always important that when you do buy a home, the community is an important factor. Those are where, if you're going to have kids or plan to have a family, or do have a family, schools and everything is something that are considered advantages of home buying. Personalization. You can personalize your home, paint it the way you want to, landscaping, updates, and that's a great advantage. And home ownership may offer certain tax advantages. Some items to consider is Maintenance and other expenses. When you're renting, sometimes, you reach out to the landlord or the property manager and, something breaks, just got to give them a quick call and they're right there to fix it. When you do own a home, that falls on your behalf to make that payment. Upfront costs, there's a minimum down payment requirement and closing costs. Market variability. Properties can vary. The property value can go up or down depending on the market and the economy. There's less flexibility to move. So if you do own a home and you're planning, maybe you want to move somewhere else. You want to leave the city, you go to a different city. You would have to most likely sell the home and able to, to make that move. Renting. What are some of the advantages? There's no surprise expenses when you're renting. You pay your rent each month, and if anything happens, you have a landlord property manager that can assist. You may have some cool amenities, a pool, gym. Once you rent, there's all type of amenities included, and you pay an amenity fee. It's always easier to move if you sign a 1 or 2 year lease. Once that lease is up, you can find somewhere else if you're downsizing or upgrading. There's less maintenance due to, what we got reiterated, and you have the property manager or landlord take care of any maintenance that needs to be done. Some items to really consider is that you don't receive any tax benefits when you're renting. You're not growing any of the equity. You have no control over rent increases. And if you're lucky enough, you may have noisy neighbors that, you're gonna have to, you can't do anything about. It just comes with the territory. Okay, can I qualify? Some of the documents to gather. So once you have a conversation and we do a pre-qualification and we do an informal estimate of what homes are within your range, and then you've identified a target amount that you want us to do a pre-approval for. You don't have to fill out the loan application, but once you do a pre-approval, there's some documentations that we're going to need in order to formalize a pre-approval letter. We may need the last 2 to 3 years of federal tax returns, your last W-2 statements for the last 2 years, employment history. When we look at the employment history, we do like to see 2 years of continuous employment. If you have switched stops throughout the time frame, that does not disqualify you from being pre-approved. You just have to see those 2 years history of when you made the switch. And if there's any gaps, usually there's a letter of explanation that you can provide saying if you had a gap between that 2 years of continuous employment history. Pay stubs, which includes year-to-date income that covers a full month. If you're earning bi-weekly, we would need 2. Monthly, a weekly, we would need 4. This has to cover 1 month. Savings and checking account statements, just to ensure that we have enough assets for the purchase. Some circumstances will require more documentation, such as divorce decree, child support, or bankruptcy discharges. Can I qualify? There are 4 factors that count the most in qualifying for a loan. So very important is a credit history. So your credit score pretty much gives us, the lender, an indication of your willingness to repay us. In addition to determining your eligibility, your score will also affect the interest rate, terms, and conditions of your mortgage loan. A higher score will definitely get you a better rate. It's always good for a quick review of your credit scores before you apply for a pre-approval. Sorry about that. I was just getting my yearly update. And so it's always good to have a great score. And if you're in the process of looking at your credit score and you see something that may need an additional review and you want to reach out to the credit bureau, it's always best for you to wait till that investigation with the credit bureau ends before you do that application. Debts. A lender will obtain the credit report and will review the debt. Generally include payment loans and charge cards you make each month. And when we look at the debts, we just go by the minimum that you would have to do each month to satisfy the debts. A good goal is to spend about 36 to 38% of your gross income on all debts. Employment history. Your job history is an important consideration. Your ability to qualify for a mortgage. The longer you're on the job, the better it is. And we do look for a minimum of 2 years of continuous employment. Down payment. Don't count yourself out just because you don't have a lot to say. With the protection of mortgage insurance, lenders can offer mortgages to qualified borrowers with a low payment. There's a misconception that you may need 20% down to qualify for a mortgage. With MCU, with as little as 3% down, we can help you qualify for a mortgage. Down payment. So we just touch up a little bit more on the down payment. When you borrow money for a home, we will require you to put a minimum down payment, which is 3% minimum. Typically, a larger down payment of 20%, which may be standard, means a lower interest rate because there's less risk associated with the purchase. But you don't need that 20% with mortgage insurance. It's going to help us qualify and help you with the dream of homeownership sooner by compensating us for losses if anything happens with the home or you're not able to continue making the payments. The cost of the PMI depends on your credit score, the size of your down payment, and the debt to income ratio. It's always important to have a lower DTI. Who is who? So there's a lot of different professionals you'll be working with on the road to home ownership. And each person provides a specific service to help you become a homeowner. And each person that's going to help you on the way is an expert in the matter. So one of the first people you'll meet is a loan officer. The loan officer, which is myself and Walter, we represent the lending institution and our loan programs. We'll help you choose the best mortgage on your situation, and we'll help you with the pre-qualification, a pre-approval, and once you're pre-approved and you've identified the property, we can always help you with the loan application. Once you have the home and you started the process for a mortgage, there's going to be an appraiser involved. The appraiser is licensed to estimate the worth of the home, so the fair market value. So if you're purchasing a home for a certain amount, that appraiser goes out and they ensure that you are paying fair market value for that home. There's going to be a closing or settlement agent. It's pretty much the party who conducts the closing. This role is filled out by one of our bank attorneys, which is also the title company, and there'll be real estate agents involved, which is usually the buyer's attorney and the listing agent. Depending upon the state where the property is located, there may not be a need for any attorneys, but generally speaking, in New York, there is an attorney present. Loan servicer is the entity that collects the mortgage payments. They pay taxes, insurance, PMI, if required on your behalf. The mortgage insurer, PMI. So when putting less than 30% down, we're going to require private mortgage insurance, and it compensates the lender for the loss if you're unable to continue making payments or if anything happens with the home. Property inspector is the individual that conducts an examination of the home. They'll look at issues that may affect the property value, and they also assess the conditions of the property. Usually they'll look at it prior to finalizing the contract, so any property conditions can be addressed while drafting the contract. Real estate agent is the person who acts, as intermediary between the sellers and buyers of the property that's being purchased. Agent can definitely provide helpful and specific community information. It's always important for you to look at the real estate agent and ensure that, you know, that person is an expert in the area that you're looking for, and they're able to answer all your questions. Next slide.
All right. Thank you, Omar. At this point, we're turning it over to Walter. He's going to take us through the payment portion and what's involved.
Awesome. Thank you, Walter Skowronski, NMLS ID 598806. Excuse me. So what goes into your payment, right? So your monthly mortgage payment is likely to include 4 parts. Typically, we call this PITI, so principal, interest, taxes, and insurance. So each one of those represents a certain part of that payment. The principal, so this would be the portion of your monthly payment that reduces the balance of your loan amount. Interest, this is what everybody talks about, the interest rate. So this is the portion of your monthly payment that is applied towards the interest that you're being charged for the mortgage. Taxes, so if you're escrowing them, it will usually represent 1/12 or 1 month out of the year of the annual property tax bill. Insurance. Property insurance is required on every home that you purchase. So a monthly insurance amount is usually included with each mortgage payment, and it's held in escrow until the bill is due to be paid. Last thing there is mortgage insurance, or PMI, private mortgage insurance. That may be required when putting less than 20% down. All of these things make up your monthly mortgage payment. Understanding credit. So we kind of touched on credit a little bit earlier. So your credit score has a huge or major impact on a mortgage, from your ability to qualify to the interest rate that you eventually get for the mortgage. As a lender, we'll order your credit report to assess your ability and willingness to pay a mortgage, meaning we're going to take a look at your history to help us determine how it's going to be going forward with your mortgage payments. It's always a good idea to order a copy of your own credit report before you apply. Your credit record can be obtained from a credit reporting agency, which are the agencies that collect statistics on individual payment records on loans, credit cards, as well as other debts. Oftentimes there may be mistakes on your credit report. That's why it's always a good idea to order your own report now, review it, and make sure that it contains accurate information. Federal law requires that each of the 3 nationwide consumer credit reporting companies, Equifax, Experian, and TransUnion, give you a free credit report every 12 months, and this is in bold here, if you ask for it. So no one's just gonna, give you this information. You have to request it. We have found that the easiest as well as the most reputable website is annualcreditreport.com. So you're going to order your credit report. Now it's time to take a look at it, right? So you're going to review your credit report. You're going to want to check to make sure that it has accurate information, or you want to check to see if there is inaccurate information. Some creditors, may not report to all 3 of the credit agencies. So your information as well as your credit score is going to vary over the 3 different bureaus. Here's what you can typically expect to see on a credit report. It'll have your personal information. It's not uncommon to have variations or misspellings of your name. I know on some of my credit cards, I'll have a middle initial. Other times I don't. So, they will leave those variations in there to help maintain the link between your identity and the credit information. So you always want to make sure that, that good credit follows you. And sadly, the bad credit's going to follow you as well. But to help maintain that link, that's why they do that. They keep all the variations in there. Account history. So this section includes each of your credit accounts as well as the details about your payment history. It's important to make sure that this data is correct. You definitely want to take a look at this. Anything that kind of looks wrong, you'll have the option to dispute those payments and/or records. Public records. This includes information like bankruptcies, judgments, tax liens, as well as court records. Keep in mind, some of this information may stay on your credit report for up to 7 to 10 years. Last thing here is the credit inquiry. So you're going to see a list of parties who have accessed your credit report within the past 2 years. And it'll show up on your credit report. Like if you applied for an auto loan a year and a half ago, it'll show up as a credit inquiry. That's what we're talking about there. So what can I afford? In addition to your lender, there's a ton of online calculators available to help determine how much of a house you can afford. Just as an easy guideline or easy rule of thumb, we like to follow the 38% rule. And what that means is your total monthly debt should never add up to more than, or should never exceed 38% of your gross income. This is what we call DTI, or I think Omar mentioned earlier, debt to income. And here's an example, just to do a quick estimate of what you can afford. There's two basic numbers you're going to need. You're going to need to know what your gross income is. So that's the income before any taxes or deductions have been taken out. And you're going to need to know what your monthly debits are. So this is going to include payments on all your charge cards, auto payments, as well as other installment loans. You wouldn't include your current rent or housing expense when it comes to this. So as a real simple example, you would take a gross income, which is before taxes, of $36,000. You divide that by 12. You get a monthly number of $3,000. What you do then is you would multiply that number by 38% to determine what your maximum debt is that you're able to handle. Then you would subtract out whatever your monthly debts are. So the $200 could be an auto payment. I mean, I wish it was an auto payment, right? Or it could represent minimum payments on a credit card, things like that. You would subtract out the $200, and then your bottom line there is the maximum mortgage payment of $940. That's what you're able to afford if you were to make $36,000 per year. Steps to choosing your home. So before you shop for your home, here are some tips to get you started. Know your budget. Whenever I'm speaking to someone on the phone, a lot of times I'll get some of our members that say, hey, Walt, just approve me for the maximum amount I can get. And, my first reaction is, well, you know your budget. If I'm able to approve you for $1 million mortgage, do you really want to have that hanging over your head? And a lot of times the answer is no. So you want to know what your budget is. You want to be able to go to the different areas that you want to live in and try to determine how much of a mortgage or how much of a purchase price you're comfortable with. Second thing here is definitely important. Do not get emotionally attached. No matter how you slice it, this is a business transaction. So there will be attorneys, there's a seller involved, there's realtors, there's negotiating going on. You can easily fall in love with that first house that you walk into, but you always want to just keep that straight face and just know that, this is a business transaction. So try not to get emotionally attached. Do your research. Make sure that you're looking in the areas that you want to live. Is living close to where you work important to you? Buy in that area then. If you're particular about where your kids go to school, buy in that area. Things like that. So you want to, just do your research. You can never over-research something like this because, this is going to be something you're going to be in for the next 10, 15, 20 years. You really want to make sure that you've thought this through. Think ahead. Think ahead is, after you do the research, right? So now you've done all this research. Now you really want to focus on, that 20 to 30 years down the road. You want to make sure, like I mentioned earlier, if being close to work is important to you, find something that's close to where you work. Definitely look at more than one house. The more you're looking at houses, over the weekend, I was watching a ton of those fixer-upper shows. And, if I would have stopped at the first house that they fixed up, I would have never have thought all these other houses would have came into play. You definitely want to take a look at many different houses, because every time you walk in there, you're going to see something that you like, or it's going to remind you of something that you absolutely need. And then that way you could talk to your realtor about it. And look, once you've determined how much home that you can afford, the next step is finding that home. It was blocked out there. I'm sorry. The next step is to find the home that is right for you. So choosing an agent. With the world of information now available at your fingertips, is a real estate agent still necessary in the home buying process? This is probably going to be the largest financial decision of your life. You are definitely going to need a buyer's agent who represents you in the buying process. Here's a couple of tips on how to help you find the agent that's right for you. Experience. Is it important for you to have someone showing you homes or helping you find the home that you want to purchase that has a lot of experience, or do you want somebody that doesn't have a lot of experience? People that tend to have more experience will oftentimes maybe not have enough time to spend with you, and they'll have their assistants helping you out. Whereas if you have someone who's not that experienced, they may have all the time in the world to answer all of your questions. It really depends on what your preference is and what's important to you. What area do they cover? I live out here on Long Island. So if I was to buy a home out here, I wouldn't use a realtor from, say, Connecticut, right? It doesn't make any sense to work with a realtor that doesn't know the ins and outs of the area that you're looking to live. So you want to make sure that you align yourself with a realtor who is also in the area that you're looking to purchase. Credentials. It never hurts to ask for references, or go check out their online profile, see what sort of properties they're selling, which leads into the next thing. Current listings. Is it important to you to work with someone who is doing a lot of business, who has a lot of listings? Or is it more important to you to work with someone who has fewer listings and may have more time to work with you? When you're looking at their listings, it may say something like they only do rentals. Is this the person that you want to help you find a purchase that specializes in rentals? Things like that. And the last thing, interview the prospective agents. Don't stop at one. Definitely reach out to a couple, reach out to family, friends, have them recommend people to you as well. You're going to be spending a lot of time with this person. You're going to, this is a relationship that can take 60, 90, 100 days. You want to make sure that you're comfortable working with them. So definitely interview prospective agents. So we have a program here at home. We have a program here at MCU called Home Advantage. So what Home Advantage does is it can help you search, buy, sell, and save on your next real estate transaction. You could use it to find the home of your dreams. They can assist in selling your existing home, as well as research the market. You'll be connected with a top local agent and save money at closing. This is available to you as an MCU member at no additional cost. So at MCU, we definitely specialize in the first-time home buyer. We do have several programs for first-time home buyers, from down payment assistance to homeownership counseling. There's a wide range of programs that can help you get into your first home. Here are some that MCU participates in. We participate in a first-time home buyer interest rate discount. We'll cover that in the next slide. That's a big one, huge seller. We'll go as little as 3% down, or we'll be able to do 97% financing. And for the remainder of 2025, we're waiving $900 in fees. So that covers your application fee and I believe your commitment fee. That's a nice savings as well. So the first time home buyer rate discount. So it definitely has some criteria that you need to fit into. You must be a first time home buyer. So what that means is within the past 3 years, you must have not owned a home or had a mortgage. The discount is 1/4% off any of the fixed rate mortgages that MCU offers. That's huge. So keep that in mind. 1/4% off any of the fixed rate mortgages that MCU offers. This rate discount cannot be combined with any of the other offers.
All right. Thank you, Walter. At this time, good job, Omar and Walter. We're going to turn it over to our friends over in business development, Deb Sanadinos, and she's going to talk about how we can help you save some money, save up for that down payment and some of the other products and services we have here at MCU.
Thanks, Dave. Great job, Omar, Walter. You gave us a lot of great information. So hello, everyone. I hope you enjoyed the presentation as much as I have. I know that many of you might be feeling unsure about whether you're ready for a mortgage at this moment. However, the information that was provided tonight is designed to help you achieve your home buying goals. I can imagine that saving money is on the forefront of your mind at the moment. And I am excited to share that MCU can assist you in your journey towards home ownership. I'm going to talk about a few things that we can help you with, and I'm going to tell you about some of the steps that you can take if you want to become an MCU member and be part of our credit union. So I like to start off with what's really exciting right now here at MCU. We have a new product. It is our high yield savings account. That account is earning 3.2%. Just take a minute and think about your savings accounts, because 3.2% is 8 times the national average savings account. That's a lot of money that we are going to help you save. We also have a great CD right now at 9 months at 4%. So these are ways that we are going to help you save that money and get to the goals, get to where you want to be. Now, MCU is a credit union, and a lot of you may be familiar with MCU. For those of you who don't know a lot about MCU, a credit union is a bit different from a commercial bank. You know, we see the commercial banks on every street corner, but credit unions are here to help people. People helping people. That is what the motto is for a credit union. And I say that because we are helping you. We can offer you the products and services that the commercial banks offer you, but with less fees and lower interest rates. So lower interest rates when you're borrowing money means that it's going to cost you less, while we're also offering you higher interest rates to help you save. It's a great opportunity to be a part of something that can help you. To start your membership with MCU, it's opening a savings account. It's easy to open that savings account. I can help you with that. My information will be at the end of this presentation. We will be dropping a link in the chat so that if you'd like more information, you just put your information in and I will contact you and we can talk further about the products and services that MCU has, about becoming a member, about how you can earn the 3.2%. We also have a bonus of promotion right now. If you open a checking account along with your savings and start a direct deposit or a payroll deduction from your paycheck, we will deposit $200 into your checking account for becoming a member with MCU. A lot of great things here at MCU besides the savings accounts and the checking. We offer loans, auto loans, credit cards. The Visa card is one of my favorite products. I think it's an excellent opportunity for someone. Credit card interest rates, 23, 24% is the average, not at MCU. MCU, we start for the first 12 months at 1.99%, and we don't go higher than 17%. We also don't charge a balance transfer fee. So all ways that we are going to help you save money. Please take my information down at the end of this presentation. Put your information in the link on the link so that I can call you and talk with you and tell you all about MCU and answer all of your questions. It's been a pleasure being a part of the presentation tonight, and I wish everybody luck in your home buying journey.
Deborah, I did
Deb,
share
thanks
some
so
of that
much.
information in the chat, and I'll also share it in the email that will go out to everyone tomorrow.
Perfect. Thanks, Elizabeth. All right, we're going to go to question Q&A now. I know we had a couple questions in the chat. Omar was looking at. So let's take a look and see what questions we have. One thing I did want to say that I don't think we touched on in the presentation is we are licensed to lend in New York, New Jersey, Connecticut, and Pennsylvania. Again, New York, New Jersey, Connecticut, and Pennsylvania for home lending. So just wanted to point that out as well. Omar, I know you said we had a couple of questions in the chat. If you want to read them out, we can answer them.
Yeah, I can pop up the question. So the first question is, if you buy an apartment in New York City, would amenities be included as well? And what's the difference between a condo and condo P?
It may have meant what's the difference between a condo and a co-op?
That's what I'm thinking.
Yeah. So what is the difference when you're thinking about buying that people should think about?
So I'll ask the question in regards to the difference between the condo and the co-op. So when you're looking to purchase a condo and a co-op, it's all about affordability. Condo, when you purchase a condo, it may come at a higher sales price and you do pay taxes, as opposed as a co-op, and where you do purchase a co-op at a lower price, and there's no taxes included. The taxes that would probably be paid for in a condo would be part of the monthly fee. But when you do purchase a condo, you own that property. And when you do a co-op, you own shares to that management company. So you own shares to the co-op, pretty much.
Yeah, that's one of the big differences between a condo and a co-op is that when you're buying a condo, you're purchasing the actual the inside of the building itself, right? The unit, you actually own that unit, where a co-op, Omar kind of touched on it, you're buying shares in a corporation. So the corporation itself owns the property, and you are buying a share in that particular company. So it is a little bit different. They usually both come with amenities of some sort, right? They're similar in that way. And there's usually a monthly maintenance fee that you have to pay as well. I know Walter lives in a co-op. I don't know if he wants to expand at all. He's used to the co-op living.
Yeah, sure. So living in a co-op is great. One of the advantages of living in a co-op is you don't have to shovel your snow. You don't have to, you don't have to do a lot of things. As far as, the structure of, how a co-op is different than, say, a condo, and I think we all touched on this. A condo is you actually own the property, right? So the unit, you actually own it. Where in a co-op, you actually just buy shares to live in you buy shares to a corporation to live in that property. So those are the two different types of that's the difference between the two of them. As far as, so what's the bottom line here, right? So in the 5 boroughs, if you were to buy a condo, one of the big expenses is going to be the mortgage tax. So for closing costs on, say, a co-op, typically it's not going to exceed anywhere around $4,000 or $5,000. Whereas a condo, when you're paying that mortgage tax, can exceed, $10,000, $15,000, $20,000. So it's definitely a big difference as far as closing costs, as well as the way title is held and things like that.
That's a great answer.
Right.
Thank you. Stephanie asked a great question that may be for multiple people, but can you define what points? You're talking about points.
I can take that one. Sure. So points represent a percentage of the loan amount. So to make it like and what you would do is you would pay points to reduce your mortgage rate. So here at MCU, if you pay 1 point, it will reduce your mortgage rate by 1/8% or 0.125%. So what does that 1 point mean? For example, if you have $100,000 mortgage, if you paid 1 point, that represents 1% or $1,000. So for every $100,000 your mortgage is, 1 point would represent $1,000. So let's say the mortgage is $500,000 and you wanted to pay 1 point, it would be $5,000. That's what points are. They reduce your interest rate by paying the fee.
Thank you. Thank you for that. Another question is, if I get a credit card for a relative, but don't give them the card, will it affect my credit score? And I guess it would depend whose social security number is on it, right?
Yeah,
Yeah,
so,
I mean, if,
go
go ahead,
ahead,
Omar.
sorry.
No, take it.
Okay, I'll go. Yeah, so if you do take out a credit card in your name, it will affect your score and it'll affect, the process of obtaining the home. You don't give it to the relative, may not affect as much because if it's not given to anyone and it's not used, there's a zero balance, but it's still an open trade line under your name and it's part of your credit.
So even if you have a zero balance, this question is, when they look at your credit score, do they take into account only the balance, or do they take into account the amount of credit you could use and the balance?
Yeah,
Because I once said, if you have cards that have like big balance, like big opportunities, like big that you can spend a high number, even if you don't spend it, it could affect your credit score. Is that true?
So
that is
pretty
absolutely.
much. Go ahead, Dave, sorry.
Yeah, no, that's absolutely true. So there's a few different things when looking at your credit score and a credit report. There's a thing called credit utilization, right? There's trade lines, which are each loan is a trade line or each credit card is a trade line. The utilization would be, say you have a $10,000 credit card, but it has a zero balance, right? That's a really low utilization. If you use 50% of the card, so say you have $5,000 balance, right? The closer you get to your credit limit, that potentially could affect your credit score and bring it down. So they do look at the number of accounts you have opened, total credit available to you. So all the open lines that you have, and then payment history is another piece of it as well. But to answer your question, yes, that having the card even with a zero balance, that goes towards the utilization piece of the credit report, and it will affect your score.
Thank you.
Yeah.
It can be tricky. It can be tricky.
Yeah.
Fiona had a question. She said, my income is 200,000, and according to my calculations, I can afford a home that's around 630,000. What are the chances that I might qualify for a mortgage slightly higher, like 699? And she also said that her credit score is in the 700s. So, I mean, obviously you can't give a firm answer because you don't have all the information, but generally, what are the rules in terms of salary, what you think you can afford, and what kind of a mortgage you can qualify for?
There's a
Yeah,
lot of
Walter, you want to
moving
take it?
parts there.
Yeah.
That's a moving target, right? So,
Fiona, call them.
and yeah, Fiona, just you see my number there? Just give me a call.
Yeah.
So it's, I guess the first thing I would say is the difference between 600,000 and 699 is not a small amount, right? So it really depends on how close you are to that 38% on the 600,000 as opposed to what it's going to look like at 699. If I was to give you a general answer, it depends. I mean, is it possible? Of course, a lot of things are possible. It really depends on your utilization of your credit. But it could also mean, like let's say you're buying something for 600,000 and the taxes, let's use Long Island, are like $1,500 a month. Or you got the same home that you're going to pay $699 for in New Jersey, but the taxes are say $700 a month. So it's all relative. So it's a matter of just doing the math, and either Omar or myself would be more than happy to help you with something like that.
Great. Speaking about that, Jane wanted to know, can you interview an agent without committing? Now, she may be referring to real estate agent, but speaking about Walter, Omar, when finding a loan officer, what do you recommend? Obviously they see you, the two of you, you have a lot of expertise. Do you recommend them giving a call to you and seeing how you feel together, or how, if they feel comfortable, what do you recommend, and what's a commitment level and what is not?
Okay, so for a loan officer, definitely want to interview a loan officer, have that conversation, and if you feel comfortable with the conversation you have and want to take the next steps, that's always important. And with MCU, there's always a website. On our website, you meet the team. And you can schedule an appointment, which I do believe you shared earlier. And
Mhm.
you'll see a list of mortgage loan officers, and you'll see, their bios, and it may provide you a little bit more context on who that person is, and if you wanted to speak to someone different. And pretty much, and in regards to an agent, you could interview with a mortgage loan officer and an agent without committing. With an agent, it's a little bit different because right now, based on the new laws, there's exclusive and non-exclusive partnerships with an agent. So you can sign as many non-exclusive partnerships you want with an agent, and that's not committed. But once you do an exclusive partnership with an agent and you select that time frame, you have to abide by that. So it's always
So you want to
important
make
that
sure you ask.
make sure you ask, and if you can do, if an agent is willing to do a non-exclusive, definitely sign that. And if someone says I only work based on an exclusive base, you give them a 30-day shot, 2 weeks, whatever time frame you feel comfortable. That if you don't feel comfortable with what that agent has provided and you want to move forward, you can with someone different.
Great. Someone had a question, Patrice, about paying off student loans and how that affects your credit score.
Okay, so paying off your student loans not only does affect your credit score, but it does affect your ability to qualify. Say if you have some student loans and they're currently in deferment, or they have a monthly payment, they do have a monthly payment, they do affect your debt to income ratio. And if it's currently in deferment, we take that amount, we use a 1% rule for your monthly payment. That'll also affect your debt to income ratio. The lower your debt to income ratio, the more you may qualify for. That's
Terrific.
something I do recommend is if you do owe a large amount of student loan, you can always talk to the lender and do a program that they offer, which is a, pay as you earn program, and they'll provide you a small monthly payment based on your current income.
Terrific. Well, I mean, I could sit here all night and ask questions, and I'm sure so could the attendees, but I do want to respect your time. And I want to say thank you so much for this information. I think, one of the things gleaning out of all these questions is just how unique everyone's situation is and how important it is to reach out and talk about your own situation so that, Walter, you or Omar, that you can speak with them and determine really what are the best next steps in buying a home. And if you do that right away, maybe you don't get too emotional about the home that you look at, because you can really arm yourself with this information. The sooner the better. Would you agree with that? The sooner the better in talking to a loan officer.
Absolutely. The sooner you get in front of one of us, the better it is. And when you ask the question of when is the best time to buy, the best time to buy is always when you're ready. And if you're ready now is the best time to buy.
Omar, that is a perfect way to end the webinar. Absolutely true.
And
Thank you so much. David, did you want to add something?
yep, I was just going to add, I'm going to put just a link in the chat. Looks like Deb put it in there as well. If you have any questions or want to reach out about any of the deposit products, again, we're one team here at MCU, so we're all happy to work together and help you any way we can. So look forward to hearing from you all.
Yes, thank you so much. Thank you to Omar, Walter, David, Deb, Deborah. So thank you so much for being here and giving us this information that is so incredibly valuable, and looking forward to having everyone work with you and find their right home when the time is right for them. So thank you for everyone for joining us. Wishing you all to stay well, stay healthy, and we'll look forward to seeing you on the next webinar. Have a great night, everyone.
Awesome.